Hello and welcome to this Forex Preview at XM.com. We'll be discussing the upcoming data out of the US and the potential reaction in the markets and the dollar. I'm Maria Pachardez, and joining me is Senior Investment Analyst Haralambos Bisuros. So Haralambos, the last time Fed officials met, they agreed to raise interest rates by 75 basis points for the third time in a row. On Wednesday, we'll get the minutes from that meeting, and on Thursday, we'll get inflation numbers for September. What are we expecting from this data? And what might it mean for future rate hikes by the Fed?
Hello, Maria. Yes, indeed, we do get the minutes from the latest FOMC meeting tonight. But given that several policymakers have been singing the same hawkish song in the aftermath of the meeting, the minutes may be treated as outdated and may have little market impact. Investors are likely to keep their gaze locked on Thursday's CPIs as they look for more updated information on how the Fed may proceed from here onwards. The headline CPI rate is expected to have slid further to 8.1% year-on-year from the previous month's 8.3%, but the core rate is anticipated to have risen to 6.5% from 6.3%, which would imply that inflation has become stickier compared to a few months ago. Now, according to the Fed Fund futures, market participants are assigning around a 90% probability for another 75 basis points hike at the upcoming Fed gathering, and they see a terminal rate at around 4.7% in March, which is slightly higher than the Fed's own projections. However, they still see rates 25 basis points lower by November next year. Therefore, accelerating underlying inflation could seal the deal for another triple hike, while an upside surprise could prompt market participants to price out some of the basis points that they expect to be cut in 2023.
Okay, so given all this, what reaction should we expect to see in the markets? And what's the outlook for the dollar?
The market reaction could be higher treasury yields, lower equities, and an even stronger dollar. Now, although many argue that the long dollar trade is crowded, the fact that investors have room to raise their implied rate path to match the Fed's projections suggests that there is more upside potential, especially without any concrete evidence that the Fed could slow down soon. Now, euro-dollar sellers could get confident to aim for another test near the 20-year low of 0.9535 tested on September 28th. And if they manage to break it, they could dive all the way down to 0.9335, marked by the inside swing high of September 16, 2001. Now, the move that could signal a bullish reversal in euro-dollar may be a break above 102, accompanied with improving economic data from the Eurozone and hints that the Fed may eventually not need to hike as aggressively as currently believed. Now, any signs that the war in Ukraine is moving towards a resolution could also help the euro and a reversal in euro-dollar.
Haralambos, thanks so much. And thanks for joining us at XM.com.